that sector gave was actually much higher than what was done even in the case of the tech boom. And this is one of the few rallies in which if you see that you had more than 4 sectors actually participating very meaningfully. Again, the point that I like to highlight is that, and this is the first rally in which banks became a force as such. So fund managers who saw that trend early enough and realized how big that sector would become actually really benefited. If you see the previous rallies, you would find that banks were not there and they were not listed in terms of large numbers, and they hadn't participated in those rallies too much. But in this rally, banks were a big factor, and from there on, in every rally that's happened, banks have tend to do better than the broad market. But again, just the sheer breadth of this market was something which makes it very different from the other bull market that we've seen. This was the rally which we saw from 2009 to 2010 after the case of the great financial crisis. So we can call it the first phase of a rally which has been boosted by a central bank. In March 2009, very few of us could figure out what quantitative easing would do and how long it lasts and what its impact would be. And now we think that is part and parcel of our life. Again, in terms of sectors, the sector width was fairly strong, and almost all the sectors participated in it. This is the current rally, which is which if you look at its magnitude compared to the past rallies, still has got a fair bit of room to move up, and in terms of the sectors have been fairly similar to what we've seen in the past. This is just a brief outline of sectors that have participated in each of these market rallies. What I'll quickly bring you to is this part, is that in terms of every rally is based on actually PE expansion as well as the case of earnings growth. And only those market trends where there is significant amount of earnings growth are the ones which last more than 2 years. So if you see the 2003 to 2008 period, almost half of the gains came from earnings growth and half of them came from a PE expansion. Whereas in almost all the other rallies that we have seen in the past, almost 75 to 80% of the gains have come from a PE expansion. And therefore, in terms of the durability of those rallies beyond 2 years, tends to be something which is more suspect. So at the stage at which we are, and I have just 2 minutes left to wind up, is that for all investors, instead of looking at the government for seeing any kind of policy action, we should all focus on earnings for the next 2 years, because if we don't get earnings from the levels at which we are, this market rally, though it has a fair bit of room for it to travel upwards, for it to sustain beyond a period of 120 odd weeks, it's going to be difficult if we don't have earnings growth, which is something which is very important. So I'll end out here on this front, is that for all investors going forward, the key factor or at least the key matter of concern or the area to focus on going forward is in terms of the earnings. Earnings expectations still are fairly low, and therefore we should not get too worried about a big crash, because there is a factor that when you have actually very high PE, you also have actually a very high kind of earning expectation, which is what happens in terms of market tops. But this time we've got high PEs, but we don't have very high kind of expectation for earnings. But over the next year, as this market matures more and it sustains the levels at which it trades, it will require in terms of earnings growth to come back, and that is going to be the single biggest factor which is going to decide how durable this rally is going to be. Thanks, and I hope you have a good day today. Thanks.
Thank you, Anup. Thank you so much for sharing all those figures with all of us. Like I said, very, very straightforward. Now, before we move on to our next speaker, I have a question at large. Do investment styles matter? How many agree with me that investment styles do matter? Just 3 gentlemen over there. That's it? That's it? The entire group over here think that investment styles do not matter? Okay, well, let's hear it from the expert then. One of the more curious aspects of Indian fund management is that labels such as growth, value, etc. count for little. Rare is the fund manager who stands up and willingly identifies himself as a value or growth style manager. To help us understand the significance of investment styles, I call upon the CIO who has the highest number of CPR1 rated funds in the country. Friends, please welcome Mahesh Patil of Birla Sun Life.
Good morning, friends. So I think most of you here think that investment styles don't really matter. So let's see, I think after the presentation, I think more of you are convinced on that. So today I'm going to talk about how investment styles really impact in terms of portfolio stock picking, but more so in terms of how they impact portfolios and how to look at when investing into mutual funds and portfolios, how to really identify various styles, okay, which are inherent, and how various styles do under various market and business cycles. So just to go forward, so we'll divide the presentation into 3 parts, okay, style introduction, okay, which are the various styles, and how do the various styles perform under different market conditions. So investing approaches has various forms. Investing into styles based on style is one of the forms. And what do you mean by styles? Has anybody idea over here? We know about normally value style, the growth style, but there are different aspects to style. You could have momentum-based style, beta-based, dividend-yielding style. Styles can also be broken down in terms of market capitalization, mid-cap, large caps. So understanding a particular trait, a particular distinctive feature, okay, which a fund manager or which a stock follows would be characteristic into a particular style of investing. And we have seen that across time periods, various investment styles have given returns. There are certain styles which have worked across market cycles and tend to give superior returns. Others have done in various phases. And our idea here would be to really evaluate some of these styles and see how they have done in context to Indian markets in the last 10 to 15 years. So let's look at some of the predominant styles which are prevalent in the market. The most common being the value and growth, okay, which normally we talk about. So when you talk about value investing was first talked about by Benjamin Graham and David Dodd in their book in 1933. And what it means essentially is that identifying stocks, okay, which are quoting below their intrinsic value. So first of all, how do you identify intrinsic value? So that's essentially depending on the kind of earnings, the current earnings, and projecting that for the foreseeable future. And really this style, it looks at identifying stocks where there is significant margin of safety. And one would wonder, why would a stock quote at a discount to the intrinsic value? Because I think inherently market, the fundamental premise of that is that the market is not efficient. Because of the various sentiments which reflect the markets, the stock could be priced significantly below the intrinsic price. And a fund manager or investor tries to identify these stocks and invest into stocks which are normally having a P multiple which is below the market multiple, or price to book value, okay, which could be below the market multiple, or even companies which are having higher dividend yield. And value investing has been, a lot of books have been written on value investing, and we've seen the great followers like Warren Buffett, okay, which follows this style, and it's tended to have generated good returns across market cycle. We'll see that in the presentation, okay, whether it has worked in Indian markets. The next predominant style is growth investing. So growth investing essentially means that looking into companies, futuristic companies which generally tend to exhibit higher growth, either in terms of sales growth or earnings growth, which is higher than the average growth for the broader market or within the sector. And here it involves a lot of speculation into the future, ability of an investor to really foresee that growth. And as you invest, look into the forward in the future, the certainty of that growth is not something which can vary. But we have seen growth investing also having its own proponents in the market, and there are various investors who believe in that style, and that also has worked well for investors. The third style which we could look at, which is slightly different, these are two more fundamental based styles, I would say. The third style is momentum investing, which means that if a particular stock is doing well, based on the price action, historical price action, that momentum will sustain and continue, and it will continue to deliver good returns. Normally, we have seen this style works well in kind of a trending market. The fourth style, which we will discuss here is a dividend yield style, which essentially talks about companies which pay out high dividends. The key characteristic of these companies would be companies generating good free cash flows. So they have enough free cash flow coming in, and the managements also believe in paying out those free cash flows back to investors by way of higher dividend payouts. So these are companies which normally have a high dividend yield compared to the broader market. And this is a strategy which a lot of funds globally, which are based on, which is as we call it, income funds, which invest into high dividend yield stocks. Again, this is a strategy which we will see has a lot of following globally. In the Indian markets also we have a few funds based on the strategy and which have got a pretty decent track record. And finally, we look into beta, which is essentially, beta means a play on the market. So investing into high beta stocks, which will move up if the market moves up, because they will follow. The market goes down, they will also follow much sharper than the market. So those are stocks which we mean by high beta. So let's look at in each of these styles and how they have performed. So the value style, we've got some data, we have done some analysis on how the value stocks have done. So when you define value, we have taken in this example companies which have got a low PE multiple and low price to book value. So if you divide all the companies across in terms of PE and price to book value, if you take the top quartile companies which are there in the top 25 percentile in terms of low price to earnings and price to book value, and how they have done across the market cycle starting from in the last 13 years, then we see that value style has actually outperformed the market across the market cycle. That's what the data shows over here. And normally it does well, we have seen that whenever the markets are pretty depressed, at the bottom of the economic cycle, and when the markets tend to turn up, that's the period when this value style does exceptionally well. Sorry. Yeah. So there is a huge outperformance over here. If you look at the outperformance can be very, very high. So in the period of 2002 and 2003, I mean in that initial period the markets were very subdued, the multiples very low, and these were the early signs of the market, the economic recovery, the market recovery. So in that period, the outperformance of some of these value stocks was significantly higher, outperforming almost 40 to 80%. And again, similar what we saw in 2009 after the financial crisis, when the markets corrected. Post that, the value stocks outperformed significantly. So the outperformance we see can be significant in short periods, when the markets are at a cyclical bottom and kind of reversing. And the underperformance, if you look at, normally when the market gets into a kind of a momentum phase, it might tend to underperform, what we saw in 2006 time frame. But the underperformance is not that large. So it gives us some kind of a protection, on the downside. But on the upside, when the markets are kind of recovering, it can lead to a huge outperformance. And more recently, if you look at it, while it underperformed in 2013, in the last 1 year, we have seen value style has done exceedingly well. Again, that's the reason was that markets at 1 year back was quoting at, a lot of stocks were ignored. They're quoting at very low price to earning multiples. And market was chasing growth because there's a premium for growth. When the markets, when the economy is not really doing that well, there's a premium for growth. There is a growth stocks doing better. Value underperformed. And in the last 1 year, again, value style has come back very strongly. Now probably at this point in time, the multiples or the market multiples have also expanded. So value might not do as great going forward. But what this study shows us that across market cycle it has done reasonably well.